Today, I'll be going over the top 10 mistakes that every beginner or new investor makes according to Warren Buffett. If you don't already know, Warren Buffett is one of the greatest investors of our time. He made his first investment at just 11 years old, and now he is 90, so he's had decades of investing experience in which he's made and seen a lot of mistakes, which we'll be learning from in this video. I specifically chose these 10 mistakes because I 100% agree with them, and I think they can help you save a lot of time and money. Hit that like button and let's get started. So the first mistake that Warren Buffett is big on isn't directly a mistake with stock investing, but it's extremely important. The number one mistake is not investing in yourself. If you got a car and that was the only car you would have for the rest of your life, you would take care of it like crazy, right? You'd be on top of the maintenance, you'd read the owner's manual, get the oil changes, right? Like it's going to be your only car, so you're going to value it a lot. That same way, you only get one brain and body. There are no second chances. So if you start taking care of yourself after like 50 years, there's going to be permanent issues that you won't be able to fix. So you need to start investing in yourself as soon as possible because the highest ROI you'll get is from yourself. So you want to invest in books, in your communication skills, your analytical skills, right? Like these will stay with you for the rest of your life and you will get continuous compounded returns from all of this. And no one can take those learnings and investments in yourself away from you. I'm currently working on myself too, like my communication and interpersonal skills. I know I'm not perfect. I realized how important it was to learn in my second year of college. That's why I started reading all these books and learning and networking and going to conferences. And I can tell you right now that my income has literally 10x because of all that. So make sure you find ways to invest in yourself as much as possible. And if you have $100 or a little amount of money, I suggest buying books with it instead of putting it in the stock market because you will get a much higher ROI and ultimately you will make more money in the long run by doing that. The second mistake is constantly buying and selling stocks. I remember when I had just started investing in the market and I would consistently be on my phone to see if I could sell and make a few bucks, but little did I know that was a horrible strategy because I didn't make as much as I would have if I had just bought the stocks and held on to them. Instead of thinking what you should be buying right now, you should be thinking about what you should be holding right now. Warren Buffett says if you owned a business that was doing well and profitable, you wouldn't think about buying and selling a new business every day, would you? That same way, when you own a stock, you own a part of the business, a very small one, but you own a part of it. So if you think that a company has a great business, then just hold on to it. It's as simple as that. There will be ups and downs, but if it's a good business, it will do well in the next 5 to 10 years. So invest into a bunch of good businesses and keep holding. You have to give your investments time to mature and make you money. Plus, you'll end up doing better than 99% of actively managed funds just by holding. So there are a lot of statistics I've heard of regarding that matter, but ultimately, according to Warren Buffett, a good investor always plays the long game. The third mistake, according to Warren Buffett, is investing in cheap stocks and companies. Warren Buffett learned to find cheap stocks and buy massive quantities of them. He learned this from Benjamin Graham, another great investor, and he calls this the cigarette butt approach to buying stocks because it's like finding a nasty cigarette butt, taking one puff from it and then throwing it away. It's free and cheap, but then you have to keep going around looking for more. And that same way with businesses, you can make money doing this, but it's easier to just buy good businesses instead at a fair price than buying a fair business at a good price. Also, if a company announces they're going bankrupt and their stock drops, then that doesn't mean it's on sale and you should buy it. It probably means that it isn't a good business and that you should run away from it. It's bankrupt for a reason, right? That doesn't mean that people are going to stop trading it or that the NASDAQ will delist that stock or anything. But if you think you're getting it for super cheap and that it will recover, you're not thinking straight because most of the time that is not the case and you will lose your money. It's basically like gambling. So just find some good companies that are trading at a fair value to invest in and just hold. The fourth mistake is not investing enough into really good stocks. The reason that Warren Buffett has been so successful, and he said this, is because he buys good stocks on a massive scale, right? Like putting most of his money into those stocks because he knows that you don't get too many opportunities like that in your life. Maybe 10 to 20 at most. So when that opportunity comes up, You don't want to invest just a little bit into it. That's just as big of a mistake as not taking any action. He says you can't make money over time by trying to find small opportunities and buying one stock today and another tomorrow when you see the price on your phone go up. You need to invest on a massive scale in good companies in order to win big. The fifth mistake is buying high and selling low. Warren Buffett has lived by the fundamental principle of investing, which is to buy low and sell high. But so many people do the exact opposite of that. You might be wondering why. It's because investors are human. I highly recommend reading Influence by Cialdini to understand what influences and drives people to make certain decisions. But basically, instead of rationally making a decision, most people make their investment decisions based on fear or greed, so trying not to lose money or trying to get rich quick. I remember when I started investing in stocks and crypto, I had this exact mentality. I would buy when the prices were really high because of all the hype around it, right? And then the next day, I'd buy more because the price went up. So I thought I could make a lot of money. But of course, this increase did not last, and then the price dropped, and then I sold at a loss. So yeah, you get the point. I feel like that's what every beginner does, and I'm grateful that I started learning not too long after. So, I didn't lose too much doing that. But people will end up buying high to make the most amount of money in the short term instead of focusing on the long term, which leads to a loss. I mean, the focus on the short term leads to investing in something crazy that is overvalued due to the fear of missing out. And then when the price drops, they don't care about what is truly going on within the business, and they end up selling it at a low price and losing money. I mean, it's ridiculous, but it's understandable because we are human. You should definitely just try to break out of this behavior. Before we move on to the next common mistake, this is just a quick reminder to smash that like button. Thank you very much. The sixth mistake is day trading. Warren Buffett is not a fan of day trading because it's not even investing, it's gambling, right? And of course, humans love to do that as well. And over the years, it has gotten easier and easier to gamble because the governments make a lot of money from it and it's an easy income stream for them. But they are playing on your weaknesses. And I've never personally been a fan of day trading or even done it because I know how risky it is. But I know there are people out there that make tons of money from it. But trust me, there are very, very few people that actually profit from it. Like I said, it's like gambling. Most people will lose money in it. For the average person, it's best to just stay away from it. I can promise that you will get much better returns from just buying and holding good stocks or index funds instead of taking on a full-time day trading side hustle as a beginner. The seventh mistake is waiting for a market crash and trying to time the market. According to Warren Buffett, if you really believe in a company and you want to invest in it, don't wait for the stock or the market to crash before doing it. You don't know what's going to happen. And if it really is a good business, it won't just last 3 or 5 years, right? So you don't have to worry about the price drop. If it's truly a good business, it will be fine and overall grow in the next 10, 20, 30 years. And timing the market is just very, very, very hard. So for example, an investor that was out of the market during the top 10 trading days, right? Meaning they sold at a high in the S&P 500 index from 1993 to 2013 would have achieved a 5.4% return instead of the 9.2% which an investor would have earned by staying in the market the whole time. So this difference in the returns means that the typical investor is much better off by just investing consistently in their portfolio rather than trading in and out of the market in an attempt to beat it. I know I'm making this video, but sometimes I still keep doing this. I'll have extra cash to put into these amazing companies, but I won't put it there instantly because I am waiting, and I can tell you right now that I have probably lost 5 to 10% in returns because of it. So it's definitely really hard to stay disciplined and not make these mistakes because, like I said, even I'm still working on some of this stuff, but over time it will get easier. Just buy now instead of waiting and just hold. The eighth mistake is paying too much in fees and expenses. There's literally no reason to pay an expensive management fee to invest in mutual funds when there are low-cost index funds available that will perform better than those mutual funds. If you consistently invest into index funds like the S&P 500, you will do better than 99% of professional hedge fund managers, right? Meaning that most people are not able to beat the market. So if you are incurring large expenses, you're making a big mistake because even a small amount of fees can have a massive impact on your wealth over time, and you will make a lot less since all those extra fees aren't being invested and you're losing compound interest on all those fees that could have been invested. I'm happy to say that I've personally never made this mistake, but I know a lot of people do. So make sure to avoid fees or only take on the fees that make sense for you. The ninth mistake is following the crowd, or in other words, buying into the hype. We've all done this. We hear something is trending and we end up buying it, and most of the time we end up losing money because of it. If you can stay objective and kind of get away from the crowd and all the hype and the news, then you will get very rich. And you don't have to be very smart to do this. Warren Buffett says it doesn't take brains, it takes temperament. There are a lot of news channels, message boards, subreddits, and social media pages out there that make money by showing tradable information. It would be dumb and very time consuming to keep up with all that. The key is to find the most valuable and legitimate information out of everything instead of listening to random people on the internet. This is why I always tell you to do your research. Like, don't just listen to me or some other person on the internet. Do your research so you know what you're getting into. Successful investors usually get information only from a few sources and actually do the research themselves. So this might include looking into the management team, looking into the financial statements, the profits, the debt, right? Like all that legitimate information. Using the news or Reddit or social media as your only source of investment analysis will likely cause you to lose a lot of money, because here's the thing. Once something becomes popular or gains traction, it's too late because that news has already been factored into the market pricing. So stop trying to get rich quick, because you will most likely lose money from it. The 10th and the last mistake is holding too much cash. Warren Buffett has, for the most part, had a majority of his money working for him in stocks, right? Like, there is no point in keeping a bunch of money in your savings account because it's losing value due to inflation. And it might also make sense to have money set aside for a large purchase that you're making soon, or a business venture that you'll be pursuing soon that you'll need money for, but the rest should be invested and working for you at all times. Warren Buffett is a big believer in putting your money into good businesses and just letting that money work for you. So take all that extra money out of your savings account and put it in your broker account. This is not financial advice, by the way. So yeah, if you can stay away from all these mistakes, you will save and make a lot of money. These mistakes can sometimes cost you all of your hard-earned money, so it's important we don't make the mistake of constantly buying and selling, and that we don't wait for the market crash or end up buying because of the hype. If you found this video helpful, make sure to hit that subscribe button and the bell besides it. And if you want, go get up to $250 in free Bitcoin with my BlockFi link down below. You can also get free stocks using my other links down below. Thank you so much for watching, and I'll see you next time.